Good afternoon from the Shreveport office of Eagle Financial, a wealth care company, this Friday, January the 19th, for the very latest edition of the Jack and Bill Show. You know, Bill, it's been a crazy week. I just saw an American Airlines flight land somewhere in the Northeast and slide all the way off the runway on ice. And I was laughing earlier because I did the same thing in my wife Stacy's Volvo, and it's a scary feeling. I broke the front left wheel, and she's without a car until Wednesday or Thursday. She's going to have to pick me up after work. So I see you have some notes over here. What are we going to ramble on about today?
Or we could just talk more about your poor driving skills for someone who grew up north. But anyway.
No, this is what I learned. It doesn't matter what you're driving, what kind of tires you have, whether you have 2 wheels or 4 wheels or 8 wheels. If you're on wet ice, you don't have a chance.
That's
so
correct.
Trust me.
And something else we should all learn is that when the people in the know say, don't drive. Anyway.
Yes, I decided on Tuesday, the day after Martin Luther King Day. I guess all this stuff hit on Monday, Sunday night to Monday. And I was walking out the door and I got a text message from Bill that was a very dismal report about the way downtown looked, with all these tall buildings and lots of shade, roads in terrible shape. And I decided to make a go at it anyway. And I only made it 100 yards out of the neighborhood. So there you have it.
All right. This is a good segue because I don't want to sound hypocritical, but I just said when the people in the know say, and really the topic of what I wanted to present today is all about questioning the narrative. So we had a narrative all late last week, going into the beginning of this week, that we would have horrendous weather. Road conditions would be very dangerous. And the local authorities and weathercasters and others told everyone, stay home, get off the roads. In hindsight, that was a narrative worth following. The narratives I want to discuss are the narratives that we see this time of year. Actually, I'd say probably ramping up more in the last couple of months of the year, but going into the beginning of the year, it's every year. You know, we get all the forecasts, market year-end targets, economic forecasts about GDP growth, interest rates, inflation, etc. And I have to ask, should we accept the narratives? Or should we question these narratives? And so I've done a lot of thinking on this, and what is a narrative? Well, a narrative, it's basically a way of explaining or understanding things, and it is a type of shorthand communication, and it is used to simplify and clarify that which is complex or opaque. We use these narratives a lot, and especially with social media these days. Who has the time in this busy world that we live in to sit down and actually read a monthly publication and contemplate and ponder the issues of the day? It's like we don't have any time for that. And we certainly don't have time to sit and read through a newspaper. I guess, well, some do. But most of us, we're just following whatever little snippet, we get on social media. And then those narratives keep building and building. And you know what? The more something is told and disseminated, the more truthful it becomes, even if it's not true. So we certainly see this in the investing world. And we've said this many times in the past, investing is hard. It's hard work. And if we can find some shortcuts to the analysis, shouldn't we use them? Like buying bonds. We can rely on bond rating agencies and the credit ratings that they assign to issuers. And we certainly look at those. We can do the same with stock investments and mutual fund investments and look at, Morningstar star ratings or, buy, sell, hold pronouncements by investment firms. And these are all just shortcuts. But there is a problem with these narratives, and the biggest problem is the validity of the narrative.
Well, if you look at about this time last year, the consensus was pretty much we were 23 was going to be rough.
Recession.
We were likely going into a recession, and now the narrative has changed to soft landing,
no recession.
No recession. I mean, I think something like 22% of economists think there's a recession, coming later this year or next year.
It was actually Bloomberg does these monthly surveys of economists, and you have to assume these are very sharp economists that they're using in their surveys. And back in 2022, the consensus was based on, I think it was 70% majority of economists surveyed was that we would have a recession in 2023. We didn't have it, and now the consensus is no recession in 2024, and it makes me go,
Yeah, and a lot of the narrative that we're hearing, or narratives, is centered around what the Federal Reserve is going to do, because they kind of made an about face late last year. The bond market really, took off, and I was haven't looked at what yields are doing today. No, they were, the last I looked, I did see there was yields were higher across the board. So this is coming off of a bond market that through the first 9 months of last year was down maybe 2 or 3%, and then I think the ag wound up being up something like 6 or 7%. It had about a 10% run to close out the year. So then we've started off this year, and there's this tug of war, I think, going on with these narratives as well. Is it a time to be in value? Is it a time to be back into the Magnificent Seven? I see big news this morning out of Meta or Facebook, whatever you want to call it. They're using a gazillion of NVIDIA's chips. And so I was talking to our colleague Dan sitting behind the camera, and NVIDIA has had spectacular growth. And given their growth rate, if it's able to continue, you can really make a case that the valuation is still okay. And some of these Magnificent Seven names, even with the in aggregate, they were up about 75% last year. They're really kind of just getting back to where they were at the end of 21.
Well, the thing that stuck out in what you just said,
end of 22, I mean, rather
regarding
end of 21,
is if these are big assumptions that we're making, and that's at the heart of narratives and predictions and forecasts, is the role of assumptions.
Right.
We're making these assumptions about the future, and we have to, because when we buy something or invest in something, we are making assumptions about that investment's performance in the future. I mean, there are some things we can't control today. We can certainly control the price we pay for something, and we know that there is a correlation between what you pay for something and the expected return in the future. Obviously, if you buy something on the cheap, the expected return is going to be higher. If you buy something at a premium, the expected return over time will be lower. I mean, that's the case for sure with a bond where you know what you will get at maturity. But the other thing is that, even in in financial planning, we're having to make assumptions in financial plans. And so that's just part and parcel of what we do is we're making assumptions about the future. So we have to be humble about these pronouncements that we make.
Capital market assumptions.
Mhm.
I was reading an article that you sent to me yesterday where we've had this 4% rule. Like,
Yeah.
historically, it's been okay to take 4% out of your portfolio. I guess some of those assumptions are, you retire when you're 65, take your investment portfolio and take a 4% income in the first year, and then you adjust it for inflation going forward. And that's kind of been the number that it's pretty much survived, every decade. But the author was making a point that uh, he doesn't think that these assumptions, hold for the future. So
And do you recall the two main reasons?
this is a portfolio that's 50%, I think 50% stocks and 50% government bonds. And I think inflation,
That's
and
one of them.
higher inflation for longer, and I don't recall the other
The,
one.
the other, lower expected market returns.
Yeah.
So the 4% rule, which has, been a good rule of thumb for distributions from a portfolio, without depleting your income, it's based on historical rates of return. There's a third one I just recalled. So making assumptions about rates of return over the long run, inflation. So the author was making a point that inflation expectations are higher than what we've been accustomed to. And here's the third one: longevity.
Oh,
So
people are, yes, I
people living
recall.
longer. Yes.
There is better than a 50% probability that for a husband and wife that are 65 years old, that one of them is going to live to be 95. So that is people, life expectancies are climbing. I think we've had kind of an aberration there the last few years with COVID. But if you think about this, Bill, the Dow Jones Industrial Average first broke 1,000 in 1966, and guess where it was in 1982?
The same.
The same.
Yeah.
So all you got during that period. Now I think stocks yielded much more back then,
They did.
and you would have done okay, I think, taking the 4%, even though some of those years like 74, 75 were really a brutal period. And that's what can disrupt a plan like that, is you start this thing and then you get into a market that goes down 20 or 30. But I think one of the biggest dangers, if you examine that period of time, I think you could liken it potentially to where we are now, because we wound up having a secular period of rising interest rates that peaked, I think, in March of 1980 with 30-year Treasury bonds paying 14.5%, and money markets at 16. So you would have been much better off earning less in a 30-year U.S. Treasury than being in a 16% money market, because you made 14.5% on a U.S. government guaranteed instrument for 30 years. So the gist of that is, what if we just went through a cyclical bull market rally in both stocks and the bond market yesterday? But
Just stop and explain the difference between secular and cyclical.
well, I think you can, the very shortest time frame that we look at is things that are seasonal or seasonality. So those are just like the weather. We have 4 seasons. You could apply
Except
that
in Louisiana.
to the stock and bond markets. And then that which is cyclical, or typically, historically, developed nations have a 5-year business cycle. So you have strong economic growth, then it starts to fizzle, and you wind up in recession. You have a recession every 5 years, and then the actions of the Fed along there. They'll raise interest rates to slow down an overheated economy or overheated inflation, and they'll do the opposite. When people think trouble's coming, or you don't have the need to worry about inflation anymore. So then seasonality, cyclicality, and then secular. And secular, interest rates, for example, I believe run in very long cycles, which I would call secular, 50 years or longer. So we had interest rates climbing, like you could say maybe from the 50s or 60s all the way up to 1980. And then from 1980 to a year and a half ago, interest rates were in decline. And so I think that's what the author of this 4% rule article was suggesting, is what if we're entering another period that's similar to 1966 to 1982, with more volatility as well. And so we've ended perhaps a cyclical bull market in bonds, but now we could be entering back into a secular rise in interest rates. And I personally happen to be in that camp. I mean, I think that we've had a very manipulated bond market, really dating back to Bernanke and helicopter money, and just throwing money at everything through quantitative easing and so forth. And now I think that the bond market's really got distorted, because if you look at Roger Ibbotson and Associates data from 1926 to present, long dated bonds have yielded 2 to 2.5% over CPI inflation, or otherwise it's not worth owning a bond if you're moving backwards. So in a taxable account, let's say CPI core inflation right now, or no, the headline number is running about 4%. Core was a little bit better than that. So that means that if you have 4% inflation, then you add 2 or 2.5 to that. Perhaps we should be getting 6.5%, on long dated bonds instead of 4.1%, 4.2%. So to me, that is not worth the risk, given that a long duration asset like that, if interest rates go up 1% on a 30-year treasury bond, it's going to lose more than 20% of its value. So whereas we have the bulk of our monies at Eagle invested in, shorter term instruments, where you can get 5.3% on short term U.S. Treasuries, about the same on adjustable rate U.S. Treasuries, certificates of deposit, very similar. But once you get out to a year or two, where the steepness, we have a yield curve where you're historically compensated maybe 1.9 to 2% more on a long dated bond than a short dated bond. And we just went through a horrific reversal of that. And it has been the last 6 to 9 months, it's been coming back the other way, to where you are compensated a little bit better on long dated stuff versus short term stuff, but not to the degree that, with the volatility that we have, that it seems like a worthwhile endeavor, to me.
Now, I want to go back to that article about the 4% withdrawal rule. Do you recall what the author said is the best approach to an uncertain future?
Well, I have my own ideas, but I do not recall.
His answer, his solution is flexibility.
Yeah, take the income out. Oh, so you take your 4% out this year, and then you live within your means.
That's right. I mean, because we can develop financial plans and come up with a withdrawal figure that should work within the model, doing all this analysis, but things happen that are unknown, unforeseen. And so his message is we just have to be flexible. And sometimes we may have to break from that withdrawal rate or that fixed dollar withdrawal amount just because times change. And so we have to be flexible.
Yeah, and I think the interest rate narrative tug of war thing drives the whole thing.
Mm-hmm.
I mean, higher interest rates are not good for the stock market. So I think part of the flexibility is we want to have very diversified portfolios, which we do, at Eagle. But I saw a news item come across the screen this morning that the U.S. government is contemplating making Social Security taxation of income for all income. I think for this year, you don't have to pay Social Security taxes if your income exceeds $168,000. But I mean, imagine someone that makes $1 million a year and pays the Social Security taxation on all that, because we've got some very secular headwinds with the whole Social Security situation. And then our debt situation, we've gone from 2008, 60
that third rail,
62% debt to GDP. Now we're something like 130+% debt to GDP. At mid-year, sometime mid-year, we're going to have $35 trillion in national debt outstanding, and these are things that are not good. Not good for the bond market, not good for the health of America,
and not healthy for political conversation. You cannot run and win office running on we have to tighten the belt. I mean, it's unfortunate, but we've just been kicking that can down the road for decades. Anyway, so it's good. It's healthy to have views, and we like to say, don't get all wrapped up in data points. It's just noise. But it is important to pay attention to trends, and trends can give us some understanding, can help us in making investing and planning decisions. But we also have to recognize that we could be wrong, and that's something that everyone in life, not just investing, needs to be willing to say, what, I was wrong, my assumptions were wrong, what I expected didn't happen, and then be flexible enough to change course. Because as the saying goes, the clock strikes, remember that? Strikes 12 twice. I mean, at some point you'll be right, but you don't want to live and die on a forecast. Now, there's a style of investing called contrarian investing, and there are people who are very successful at using contrarian investing using that as part of their toolbox. And contrarian investor is basically going against the herd, going against the consensus. So let's just say right now the consensus view has been the Magnificent Seven, these mega cap tech companies. They've been driving the returns in the major market indices like the S&P 500 and the NASDAQ. So the consensus view or the consensus period could be, this is where all the money's been made, continue doing that. And a contrarian would say, well, I'm not going to invest money in the things that are in vogue. I'm going to invest in that which is out of vogue. those things that are unloved. And that kind of strategy has delivered results. And it's Warren Buffett himself. Warren knows a thing or two about investing. And he's the one who's famous for saying, be fearful when others are greedy, and be greedy when others are fearful. And that, in a nutshell, is contrarian investing.
Yeah. And that will work very well, provided that you're correct.
Well, be consistent and disciplined. The other thing I was thinking about, Jack, is this 24-hour news cycle. It's like now that we're in this, and we've been in this 24-hour news cycle for decades. This is nothing new. But there has to be programming. There has to be content. And so the talking heads always have to have something to talk about. Well, maybe there's no news. They will find something to talk about. And it's the same with financial news. They have to have something to talk about. And so these people are pressured to have answers. And it could be the news forecasters. It could be, and it's specific to our realm, it could be market strategists, economists, financial analysts, even people at our level.
Or what happened to
pressure.
Mike McCarthy and Dak Prescott and the Dallas Cowboys last weekend.
Oh, we could have a lot of fun with that one.
They were heavy favorites, and
consensus was wrong there.
Yeah.
But yes, there is so much pressure. And
they were unprepared though.
No, okay.
So they were. I mean, all the criticisms that I saw, they came out to that game overconfident and underprepared, and in every aspect of the game, they got their butts whipped. So that's one way to win the game.
I thought it's because the symbol on their helmet. There's like hexagon, pentagon. Theirs is a season's gone.
Season's gone.
But yeah, I just getting back to this idea of this pressure. There's so much pressure, especially for people who are paid to give forecasts, and people look to them for answers. And especially when the future is unknowable, we look to the experts to guide us, and often it's the loudest voice that is ascribed as an expert because they have the loudest, strongest views. But as we know, they don't always pan out. I was also thinking how, we are like wholesale consumers of these financial narratives. So they're coming from Wall Street and other sources, these narratives coming down, about the markets, about interest rates, whatever. We wholesale consume them. And then it's at our level that we kick the tires. We decide what we want to keep, what we want to throw out as garbage. So we have to filter this, and then we deliver what we believe is the best advice to our clients. There's the retail. So we're at the wholesale and our clients are at the retail. But I think, what are the three most popular words in our industry? This is Bill wisdom. The three most popular words in our industry: I don't know. Now, that's not what clients want to hear, but unless you're trying to deliberately hide something, we can't possibly have all the answers. And sometimes it's best just to say, I don't know. But at least I know where I can go to get some answers. And why are we any different than, say, a CPA or an attorney? Do you think a CPA knows all the tax codes? Do you think an attorney knows all the laws and regulations? No, it's impossible. But they do know where to go to get answers. And so that's important too. Just being able to say, I don't know, but I'm going to do my best to help you. And that is a trustworthy and humble response.
Yeah.
So that's enough of my soapbox. You want to jump on yours?
Yeah, I see. I see you have some notes here about year-end market targets and interest rate forecasting targets and inflation targets.
I think a lot of that you can just throw it in the trash. Throw it in the trash. I mean, you have these people prognosticating about year-end market targets and all that. It's really worthless.
Yeah, it's really going to be. I mean, and that's what we try to do. We like to look at the intrinsic value of our investments. We like in this market climate, we like as much income as we can get, and the Federal Reserve really did help us with that, in the last 18 months. But we've been through some pain with that. I mean, I was looking. Long-term bonds are down to 11% on a total return basis for the last 36 months. The ag is still down between 3 and 4% in the last 36 months. That's counting, reinvested income. So fortunately, we've been postured in shorter term things, and we've made money, in the bond market. But I think that, with what you just said, I'd like to say that I think that there are a number of risks that we need to be aware of. That we're very late in the economic cycle. The Fed did a decent job, I think, at getting inflation back down to where we are, but there's some evidence that could be tough going from here. And one of the things that we try to do with all of our clients is we do outperform in down markets. We might lag a little bit in up markets, but in a market climate like what we're in right now, late in the economic cycle, potentially a secular, bond market trouble, I think we target reasonable returns without undue risk, and we have many engines of return in our client portfolios.
That's very important.
And whether it be high quality BDCs, business development companies, adjustable rate, bank style loans, managed futures, the multi-asset strategy that we own in managed futures that we love with an MSCI World Index overlay, value stocks. We have in the stock market core versus passive. We've got some indexing in there so that we do capture the growth stuff if it keeps on going. And we do like the equally weighted NASDAQ and S&P 500 now more, in this climate, but just many short-term fixed income better than long-dated fixed income, and just very diversified. And we're students of the market. We're always looking to improve upon what we're doing, every single day. And that's my narrative.
Yeah, no, that's
Bill.
good. That's good. And I'll just end with this, and then you jump in if you guys have something else to share. When I talked about the 24-hour news cycle, just think if we could turn that off, how much more unified our country would be. It's the social media, it's the 24-hour news that's dividing our country. It's the social media and 24-hour news that is keeping investors very anxious and making them to feel like they have to be more proactive. And sometimes the best thing is turn it off. Don't look at that every day, and just rest and let this stuff work.
Yeah, and I do have another comment along those lines. Is there the investment returns that an individual or an institution earns on their investments oftentimes is determined by the psychology of their investments, and that is making the right choices at the right times. And part of this, I would say, for retail investors, I've I believe there's a high degree of correlation to how frequently you look at your investments and the changes that one makes. Okay. In other words, if you look at your brokerage account every single day, you're going to be inclined to get shaken out of things more frequently. Whereas, if you throw your statement in the corner and look at them every 2 or 3 months, you're going to be less inclined to be worried about things.
That's true.
And sometimes you just need time in the market, and I do think it's very important to have a plan, to know why you own what you own. And I'd throw that out there. We welcome any phone calls or anyone that would like to have their portfolio reviewed, or if you're a client of ours and you'd like to give us a phone call or come in, our door's always open.
All right. Well, with that, I guess that's a wrap. We wish you all the best. Stay safe, stay warm. Until next time.
Alrighty.